Hi everybody, this is Brian Kasal, the Chief Investment Officer and CEO of FourStar Wealth Advisors in Chicago with our second quarter commentary. Basically, the markets this year have been very sloppy. As we mentioned in our first quarter commentary, the markets had collapsed on the open of the year, a continuation of the decline that started in May of last year, and very difficult January. And then since that time, we've had a recovery in the market as it's basically come all the way back up, with the Dow up as we speak on the 4th of May, about 1% on the year. So generally, on a year when the markets are down, in the beginning in January, the markets for the year are down as well. So if that was the case, that wouldn't be a surprise. It would be probably statistically accurate. But it seems like the market wants to go higher. Now I say that in the environment where we now have a very sloppy market in the last week. Our indicators have now all turned positive, and right around that time is when we get a sloppy market, of course. But that's typical of markets that rally for a period of time, then they back and fill and go through this process to go to the next level if they're going to go up. So that's what we're seeing right now. Our indicators are still positive, and our posture is still positive at this point. As of January, we were negative, and we were negative most of last year. So it looks like things, we think the odds are, go higher. So the internal signals, we've seen some trend changes. Precious metals have come into many of our models, including gold, and we've had some really strong rallies in gold. Utilities have come into our models as well. So there's been some changes in leadership in the markets. Those are changes that are just not necessarily represented, however, with long-term bull markets, but that doesn't necessarily mean they can't be. So we're in that position right now. The indicators that we track are 70 to 75% accurate, which means that some of the time they're not accurate. There is no foolproof strategy. There's no way to guarantee that this is a bull market, but right now it appears to be a bull market from our work. As I said before, as I have said before many times, all you can do is put all the odds in your favor, the best odds you can, and hope for the best and protect yourself on the downside in case things are wrong. Let's turn to the economy at this point. Fourth quarter revisions went back higher to over 1.4% for real GDP for the fourth quarter. So now the first quarter numbers were expected to be very weak, but the consensus is 0.7%, but we think it'll probably be higher. But the real GDP about 1.7% from higher than last year's GDP. Consumer spending and home building are the strongest. The Federal Reserve is looking at a rate increase everyone expects somewhere around June. The metrics that would lead the economy to show interest rate increases and strength are all there. Employment growth is strong. We're starting to see strong employment growth. That is usually not what happens before a recession. Usually before a recession, employment growth is declining. So we're seeing employment growth. And manufacturing, which hit a bottom in February, has started to go back up. And the ISM number that came out just today was at the number 55. Anything above 50 is an expansion. So that's a good number. On the other hand, OPEC, with oil prices, fracking, new technology, changes in oil technology, is, as Ronald Reagan had once said, in the ash heap of history. Basically, the cartel is not able to keep prices high and keep profits high, so now it's really an open market. It's a very interesting situation. Recall, oil prices in the 1970s went from $3 a barrel to $18 a barrel virtually overnight, and that created such disruption in the economy. We saw in 2008, oil prices went to $140 a barrel. We're in the kind of 40 to 50 range, back and forth right now. That would be the equivalent of tomorrow we wake up and oil prices are at $300 a barrel. That would be hugely disruptive to the economy, and that's what happened in the 70s. We don't see anything like that happening now, but it's very interesting. Oil price declines, first were a slowdown in the economy, but they're also a positive for the consumer spending side because people have to spend less money. If you've gone to the gas pump lately, and gas prices in Chicago are some of the highest in the country, but we're paying $4 and $5 a gallon for premium. Now it's $2 and $2.50, which is interesting. So our posture, based on the things that we're seeing, we had been defensive since last summer. The signals we got June through August caused us to be defensive. As a result, the client performance for our accounts at FourStar Wealth Advisors were some of the best in the country because we were able to get out of the declining markets. We see more choppiness in the near term. We said that before, that's held true. Then we began a recovery in the markets. We said at the time we were constructive in the long term. That's come true. The markets are actually acting a little bit better. So right now our indicators are on offense. We'll maintain that posture until we get better evidence, but it appears the markets want to go higher at this point, and we believe there's a 70-75% chance that that will happen. I always have a segment called Things to be Worried About, and high yields attract investors. Outrageously high yields attract fools. So many people are invested in things that offer significantly more risk than they realize. We've seen REIT stocks decline sharply in this recent decline. They offer high yields, but their price movement is very volatile, not like bonds. Last year we saw master limited partnerships, the oil partnerships with 4 and 5% yields, take a 45% decline for the first really big down year in a while. Now they've shot up quite sharply this year so far with a flat stock market, and master limited partnerships, oil partnerships are up 12, 13, 14% for the year. So make sure that if you're in income securities that offer more risk than bonds, that you understand what those risks are. Floating rate bonds have been very strong lately as well. If the Fed does raise rates in June, a continuation of the rate increase that they did last year and the trend of rate increases, then floating rates will offer a good hedge to your bond portfolio, because floating rate bonds, the yields will go higher and get reset higher over time as the Fed raises interest rates, where more traditional bonds have fixed interest rates. So floating rates can be a very good hedge in an environment like this. So those are just some things to be worried about. So putting it all together, we wanted to make the comment, as we made in the past, that markets are deemed to call recessions. So the adage goes, the market has called 10 of the last three recessions, which means basically markets will decline and there won't be a recession quite often. And that's pretty much what we see at this point. The signs of a recession are not here. The market decline happened and now we've recovered, so we think that's pretty much what it was. But employment is usually a leading indicator when the economy is going down and we have a recession. We have employment rising now. Most other metrics, while taking a little bit of a haircut in February and some into March, have turned better. We've got the manufacturing index turning up nicely here in March. So there's some good signals right now in the economy. So we don't think there's going to be a recession right now. We recommend, again, if you can't take risk with any dollars, you shouldn't. Many investors are at a quandary right now. Do I take zero in a money market and make sure I have the money? Do I get 1% in a CD, maybe 2% in a corporate bond? That isn't much yield, so people are stepping out and taking more risk. And we would argue that if you have a long-term perspective on those dollars, you can do that. But in the short run, if you need that money to be available, you shouldn't take that risk at all. So a money market or something really safe would be a good thing to do. Many people will buy stocks on the way down, as some did. Some people will wait till markets to recover and get signals. We would argue that both of these methods over time will yield good results. But I think the thing is to make sure that you have a strategy and stick with it. And the key is to have a plan. Buying on weakness can work. Waiting until the markets recover and buying into strength can also work. But the key is to make sure you have a plan. So one old adage I wanted to pull out today is, when a trade happens in the stock and the bond markets, there's a buyer and the seller, and they both think they're astute. So the key is for you to have a plan that works for you, not necessarily what someone else thinks. So those are our thoughts for the second quarter. We'll be back with some commentary in the third quarter. This is FourStar Wealth Advisors here in Chicago.